Hi, this is Professor Wheeler at the University of South Florida School of Accountancy. In this video, I'm going to talk to you about basic concepts in AIS, that is, Accounting Information Systems.
In this lesson, we're going to cover Part 1 of our AIS overview. Okay, let's start with some basic definitions. What is a system? A system consists of interrelated components or subsystems that work together to achieve a common purpose or objective. An information system is a collection of resources designed to transform data into information. An accounting information system, AIS, is a collection of resources designed to transform business data into accounting information. So we notice a series of steps here, nested steps. We first start with a system, then we go to an information system, then to an accounting information system. So there are systems that are not information systems, there are information systems that are not accounting information systems. An accounting information system performs this transformation either manually or automated. That is, the accounting information system can be implemented either paper and pencil or computerized or some combination of the two. Our basic systems model, in this case, is a manufacturing process, a manufacturing plant. It consists of metals, tires, people serving as input. Then there's the manufacturing assembly process. There's the output of the automobiles. So the basic systems model is input, process, output, sometimes just called the IPO model. Once the output has taken place, once the cars are manufactured, they're used various ways by drivers, companies. They're going to go through inspections and tests. And if the result of these inspections and tests is that the output is a good automobile, then feedback will occur back into the system, back into our process, that no changes need to be made. However, if there are problems with the car through inspections, through testing, through driving, feedback will be that some changes do need to be made, either in the material that is input or the processing, the manufacturing, and assembly. Okay, so this is a basic system example. Notice it's not an information system. It is not an accounting information system. A basic AIS model, accounting information system model. Again, you'll notice we have the four components that we talked about of our model: our input, process, output, feedback. In this case, the input is data from financial transactions, non-financial transactions. Financial transactions could be things like ordering inventory. Non-financial transactions might be something like a survey of customer satisfaction. Okay, this various information, this data, is put into the system to be transformed into information. And this transformation process, just like the building of a car, includes certain procedures, mathematical rules. We find these in GAAP, we find these in IFRS, for example. Some process by which we add together this financial data. We take our journal entries and put them in a ledger, into accounts, account balances, into worksheets, and over into financial statements, income statement, balance sheet, etc. So just those basic rules of accounting are the process. Out comes information, this data that has been made useful by that transformation process. And then it's used by various decision makers. Could be stockholders, could be managers. Again, this information is inspected and used and tested. For example, it goes through an audit process. Users themselves are constantly testing it for its usefulness. It's tested against various objectives. For example, GAAP provides us some examples and rules of what is good information, good accounting information. We also have audit standards. So from this testing and inspection and auditing, we get feedback. If the reports are accurate, then no changes need to be made. If the reports are inaccurate, then again we go back into the system and either change the data input or the processing. Alright, some Basic system characteristics. We already talked about goals, objectives, and purpose. A system needs to have these in order to distinguish the input from the output, that is, the data from the information. For data to be changed into something that is useful, we must have standards, and we must have processes by which this occurs. Also, we need goals, objectives, purposes for control purposes, internal controls, auditing standards. As we just mentioned, these output information, financial statements, for example, must meet certain standards defined by the audit standards, by the SEC. So those controls check that information, those reports, for compliance and accuracy. And if they're okay, then you can continue the process as is. If not, then changes need to be made. Systems are subject to entropy. That is, systems decay, they naturally break down, become disordered, unless effort is put into the system to maintain them. Information is going to lose its informativeness, that is, its relevance or reliability over time, unless effort is put into the system to update the information as things change. The problem of sub-optimization. So what is good for one part of a system may not be good for another part of the system, or may not be good for the system as a whole. For example, the individual might be seen as a subsystem of society. The goods of the individual may not be the goods of society. The same with the division in a company and the company itself. What benefits a department or a division may not always be a benefit to the company overall. A little more on data. What is data? Data are primary and raw observations. For example, counting inventory, measuring the dimensions of a box in inches, noting a date. Now notice that to be used in an accounting information system, the observations have to be quantified. That is, they have to be put in numeric form. Our basic transformation of the data is going to involve math, so we need numbers to do that math. Our journal entries are quantified as monetary units. Journal entries are summed up into account balances, and on we go through the worksheet, spreadsheet, and into the financial statements. What is information? Information is data that have been transformed into a form that is useful to somebody. Now recall, information usefulness is defined by the system's goals and objectives. We do not know if the data has become useful unless we know what is the purpose of the system. What is the purpose the users want to put this information to? Information is useful if it helps a person, a user, make a decision, solve a problem. Again, that defines to a large extent our goals and objectives. Information usefulness depends on the situation or the problem a person is concerned with, and what is information for one person may not be information for another person. Financial statements may be informative for stakeholders, but not so informative to managers. What are some of the users of our accounting information? Stockholders, investors, creditors, government agencies. These are all users. They have different goals and objectives, but they use our accounting information that is the final output of our overall system. Thank you.